I hate it here. Nothing makes any damn sense. Inflation way higher than expected today. We've now breached 5%. And what does the bond market do? It surges higher, of course. We were at ridiculously low, in the 1.5% range of, for the 10-year Treasury bond over the last week or so, last I checked. And today, by the end of the day, we're at 1.44%, when the CPI, which is the government's incredibly understated and heavily manipulated inflation rate that's well below, the real inflation rate, is at 5%. And so that means that I would say, conservatively, the real rate of return on a 10-year Treasury bond right now is like negative 8%. Because I think CPI, realistically, it's probably 1/3 of reality. Let's just say conservatively, it's 1/2 of what inflation is in reality. If that were the case, and let's say assume 10% inflation, well, then you're making a negative rate of return of 8.5%. That is, it's costing you 8.5% a year for the privilege of holding a U.S. Treasury bond. And as inflation goes higher, people want to hold these bonds even more. I have to say, I think we're reaching the point to where I'm an amateur at understanding finance. I don't have a lot of money, but I find the economy very interesting, and we live in an incredibly financialized economy. And so that is why I kind of have to focus on finance a lot. But we're getting to the point to where I don't know what to think anymore. I mean, before I even get to how high inflation is right now, which that's a story in and of itself, but I mean, I'm just having trouble coming to grips with what this means. What is the logic of somebody who's buying bonds right now as inflation is rising? Even if you think that inflation is transitory, you need to price in the risk that it is not transitory. If inflation is higher than expected, that would show that the risk that inflation is transitory there might be a little more risk there than the market had previously priced in. So at the very least, we don't know when the market moves. We can't say value-wise how much it's supposed to move in which direction. Economics doesn't tell us that. But economics should, if you understand everything that's going on in the market and all the market dynamics, you should be able to gauge pretty reliably which direction the market is moving up or down. And so when the CPI number comes in higher than expected, that is evidence that there is, more risk in holding a bond, particularly when that bond is yielding below the rate of consumer price inflation. When you buy a 10-year Treasury bond at 1.44%, you factor into that the rate of inflation, or at least a normal rational investor would. I guess a pure speculator wouldn't. Somebody who's just planning to buy the bond and sell it later, assuming it goes up, which you can certainly sustain a bond market that way. Look at Europe, where they have nominal negative rates. People still buy bonds because they expect that the rates will be even lower in the future, and they'll be able to sell these bonds at a premium. But putting that aside, assuming that you're buying a bond that you plan to hold to maturity and collect the interest on, and then get your money back at the end of it, you are betting that inflation, if you want to make any positive rate of return, you are betting that inflation on average over the next 10 years is going to be less than 1.44%, because if inflation is at 1.44%, or God forbid higher, on average over the next 10 years, you have either made nothing or you are losing money. And so if inflation in the here and now, in the current year, 2021, is substantially higher, not only than that 1.44% number that you're betting on average is going to be higher than the rate of inflation over the next 10 years, but it's higher. It's even higher than was expected. Don't you think that there is some risk that perhaps the rate of inflation on average over the next 10 years is going to be higher than that? Hell, look at the 1-year bond. That's yielding like 0.5%. So that's people betting that over the next year, really, the rate of inflation is going to be less than 0.5%. Either that, or they're just fine losing money on that. They are willing to accept a real rate of return that is negative, significantly negative, because year over year right now, if you bought a U.S. Treasury bond a year ago, I'm going to guess that it was yielding no more than 1%. You lose. I don't know exactly what Treasury bonds were yielding a year ago, but again, assuming you bought one a year ago and held it to maturity now, you would have lost like 4%. And this is not something that a normal bond market is supposed to do. I mean, I think I did. Gosh, didn't I just have a video a couple days ago saying negative interest rates are here? Hell, if I needed any more confirmation, today was the day that did it for me. This is the era we're living in. We in the United States here are no longer can distinguish ourselves from Europe. Sure, Europe still they have nominal negative interest rates. We still have nominal positive rates, but who cares? Nominal interest rates never matter. It's always the real rate of return that you have to look at. And right now, junk corporate bonds, I think in many cases, are yielding negative real rates of return. And when I say rate of return, I don't mean the change in the price. You buy a bond and then you sell it later for more money. I'm talking about the interest rate. If you're looking at a bond as an investor, not as a speculator, your rate of return is the interest rate. You're not speculating on a bond to buy it today and sell it a year from now, for more money, even though the interest rate is negative. And I hate to dwell on this for so long because I feel like I'm burying the lead, which is that inflation is really getting out of hand. Month over month, it's even more concerning. It was core CPI was up 0.7%, regular CPI was up 0.6%, and annualized, that normal CPI number 7.2%, and the core number was 8.4%. So that's where we're at right now. If this inflation is transitory, you would expect, well, the rest of the months in the year probably will be lower than that. It won't be that bad, and so it'll average out to be, a more moderate number, maybe 4%. But if this is not transitory, we're going to continue to see inflation on a month-over-month basis continue at rates like this or even higher. And so on an annualized basis, we could see double-digit CPI by the end of this year or by early next year. Because right now we're in an inflationary economy. Production is not increasing. I've been talking about this over and over again. Less and less people are working. We have, what is it? Over 9 million job openings. People are not going back to work. I mean, I hear that the lumber shortage is easing and that's going to, be a little less extreme. Prices are not going to come down to where they were, but they'll at least moderate to a certain extent. But in other sectors, I haven't seen evidence that that's going to happen. Because if the federal government now takes away the punch bowl from all these people who are receiving enhanced unemployment benefits and tells them, hey, go back to work, just in the same way that Kamala Harris came out and said, hey, all those of you who are coming and crossing the border because, Joe Biden ran on being soft on the border, don't come here. We don't want you. You're not welcome here. And if you try and walk all the way here, you're probably going to die and you're a bad parent. And so I guess it is possible that they could flip-flop and say, you know what, everybody, go out and get a job. No more free money for you. I doubt that could happen, but if they did do that in the name of fighting inflation, which they wouldn't do, because they don't even understand that that's what's causing the inflation. They probably blame, I don't know, they blame shortages. That's what, that's the excuse that people are using right now. Oh, there are shortages. Well, yeah, that's what happens when you artificially increase demand without increasing supply. When people are just handed purchasing power, or rather, if they're just handed money, that's not so much purchasing power. There's not, if there's nothing, if there's no more stuff to purchase, then society on net is no more richer. And so, yeah, if people all of a sudden have so much more money to buy things, but there's no more stuff to buy, well, then, yeah, it'll look like that there's a shortage for a while. But those shortages will go away once prices adjust to the new monetary reality. But getting back to what I was saying before, they can't just end this, because right now we are in an inflationary economy. This illusion of prosperity is, at this point, pure inflation. All of this demand that can't be filled, all these shortages that we think, oh my gosh, because the economy is so hot, that's just inflation. If your economy is, quote, running hot, and you have a lot of, quote, shortages of goods, that is just inflation. Its prices haven't gone up yet, but they're going to have to go up. And, at that present, moment in time, when as prices start to rise, that will tamp down on all of this demand. All of a sudden, people who received all this free money will not be able to buy as much with it. And so what is the only way to keep the sugar rush going is you have to inject even more and more money into the system. This is the problem that the Fed found out with the financial economy after 2008. Trying to do that, they found out that they had to inject more and more QE every round. They thought they were just going to do QE1 and that was going to be it. But then they had to do QE2, then they had to do QE3, then there was the taper tantrum, and then there was a balance sheet runoff on autopilot, and the Christmas Eve massacre, and then they had to do QE infinity. And so now the federal government, the Biden administration, finds themselves in the same predicament with the consumer economy. They must continually inject more and more stimulus into the system in order to perpetuate the current state of affairs, which is not good in my opinion. It's terrible. But to them, it would be worse for this to come to an end and for the whole house of cards to come crashing down. And so the most likely scenario here is ever accelerating inflation. Inflation is transitory by definition. It goes away eventually. But it only goes away when the monetary authority decides to stop injecting new money into the system. Jerome Powell has made it absolutely clear he's not going to do that. There's not going to be a taper. He doesn't have the stomach for it. He didn't have the stomach for it in Q4 2018 or Q1 2019. That was when he put all of that to bed, all to rest. He said, hey, he told the world, I'm an easy money guy. I'm going to print until I drop. And so no matter what, the corrupt and brain-dead bond market would suggest, that is what is going to happen, at least until, the Fed, principally, but also the administration and the Congress, changes their minds. But they've shown no indication that they're going to do so. And so why would you assume that a group of people is going to do something that's completely counter to every indication that they've given, and they've shown no signs of growth or of a pivot point or of some change in their mindset? With all that said, I can only regard people who still believe that inflation will be transitory, and that it will just sort of go away as, I don't know, mind readers, as wishful thinkers, because all the evidence is against them in that assertion. So that's where we stand as of now. As I discussed a couple days ago, the narrative amongst ordinary people is shifting. Ordinary people see it. I had somebody I know call me today, and I was saying, oh, hey, I found this dealership. They're selling trucks for only $51,000 stripped down, a stripped down four-wheel drive truck, over $50,000. And this was a good deal to him, which it is right now. That's, oh my gosh, you found trucks, diesel four-wheel drive under $60,000? Wow. Everything is going up. It's not like, this is limited to certain sectors. It's not like it's limited to the stock market anymore, and people can't make the connection because they say, well, gee, my rent is stable, or actually rent is kind of stable. But, hey, housing prices are kind of stable, or food prices are kind of stable, car prices are kind of stable. What do you mean there's inflation and, but their portfolio's up, 15% year over year? But with it being everywhere, with it being not just in the stock market, this is, this is what the Fed's worst nightmare has been for a long time. The Fed was very happy with high inflation in asset prices. It's something that they worked towards for a long time. But with the help of the federal government, the Fed has finally been able to take their inflation and make it mainstream. So this is simply a classic story of supply and demand. Demand cannot increase against supply without prices rising. So with that said, I can hope that things get better. I hope that this video ages poorly. I hope that things calm down. I hope that inflation was truly transitory and that we can all live for free off of the government teat for the rest of our lives. I'll very happily move into my pod and eat my bugs as long as I can do that for free and not work and just sit at home and watch TV all day and, drink my strawberry flavored nutrient shake. But silly old me. I'm old-fashioned, I think, in terms of economics, in terms of scarcity, and I just don't think that this post-scarcity world that, the MMTers necessitate in order for their schemes to work exists at this point. So, I'll see you folks back here tomorrow.